Welcome to Moon and Margin. Ray Dalio, one of the world's greatest investors, built his success by adhering to timeless principles. I've read his works and summarized his lessons in this video. Be warned, Lesson 18 might wake you up because it applies to today's market environment. We'll explore a total of 20 essential investing lessons, from market cycles and diversification to risk management, behavioral finance, and building resilient organizations. Get ready for deep insights, historical case studies, and practical takeaways that have guided Bridgewater Associates to become one of the world's largest hedge funds. Before we dive in, just a quick disclaimer. This video is for educational and entertainment purposes only. Nothing here should be considered financial advice. Always do your own research and consult a professional before making any investment decisions. Now let's get started. Lesson 1, Understanding Market Cycles. The economy is like a machine. Understanding how the machine works is essential for navigating markets successfully. Dalio stresses that markets are not random. They follow identifiable cycles. Recognizing both short-term swings and long-term trends is crucial for making smart investment decisions. Case study. The 2008 financial crisis exemplifies a long-term debt cycle reaching its breaking point. Excessive borrowing, particularly in the housing market, led to asset bubbles. When the bubble burst, debt deleveraging caused widespread defaults, financial institution failures, and a deep economic downturn. Central banks had to step in with aggressive monetary policy, including near-zero interest rates and quantitative easing, to stabilize the economy. Investor takeaway. Monitor economic indicators and prepare for both booms and busts to safeguard and grow your portfolio. Dalio strongly advocates for monitoring economic indicators like debt levels, central bank policies, and productivity trends. Lesson 2, The Power of Diversification. The key to success is to have 15 or more good uncorrelated return streams that are not dependent on each other. Diversification is not just about having many stocks. It's about ensuring those assets do not move in tandem. This reduces overall risk while capturing a broad range of opportunities. Case study. During the 2008 financial crisis, Ray Dalio's risk parity approach, which balanced stocks, bonds, and commodities, outperformed stock-heavy portfolios by reducing downside risk. Investor takeaway. Build a portfolio that spans asset classes, industries, and geographies to buffer against volatility. Lesson 3, Risk Management and Decision-Making. Make your decisions as expected value calculations. Every investment is a bet on the future with probabilities. Dalio advocates for a systematic, quantitative approach to investing, where each decision is measured by its potential risk and reward, stripping away emotion. Case study. During the 2008 financial crisis, many hedge funds and institutional investors suffered massive losses due to excessive leverage and poor risk assessment. However, Ray Dalio's firm, Bridgewater Associates, managed to navigate the crisis successfully by applying rigorous risk management and probabilistic decision-making. Dalio's all-weather risk parity strategy, which spreads risk across asset classes, stocks, bonds, commodities, and currencies, helped the firm avoid catastrophic losses. By factoring in economic indicators and using systematic analysis, Bridgewater was able to anticipate the downturn and adjust its positions accordingly. Investor takeaway. Adopt a disciplined, data-driven process to evaluate opportunities. Always calculate the risk-adjusted return. Lesson 4, Managing Fear and Greed. Fear and greed drive markets more than logic. The biggest mistakes happen when emotions take over. Investor psychology often leads to overreactions. Recognizing these emotional cycles is key to making rational decisions. Case study. The late 1990s saw a surge in internet-related stocks as investors, fueled by greed and speculation, believed every tech company would become the next big success. Traditional valuation metrics were ignored, and companies with no profits or even viable business models were seeing their stock prices skyrocket. As the bubble burst in 2000, panic, fear took over. Investors rushed to sell off their holdings, causing a massive market crash. The Nasdaq Composite Index, which had soared to over 5,000 points, lost nearly 80% of its value over the next 2 years. Many once promising companies went bankrupt, and billions of dollars in investor wealth vanished. An investor takeaway: keep emotions in check. Focus on fundamental analysis rather than succumbing to market noise. Lesson 5. Understanding inflation and interest rates. Inflation and interest rates are two sides of the same coin. They dictate the purchasing power and cost of capital. Dalio explains that rising inflation erodes purchasing power, while interest rates reflect the cost of money. Their interplay can significantly affect asset values. Case study: the stagflation of the 1970s serves as a stark reminder of how mismanaged inflation and high interest rates can cripple economies. Investor takeaway: monitor inflation trends and central bank policies. They are critical for long-term investment planning. Lesson 6. Liquidity and market dynamics. Liquidity is the lifeblood of the markets. Without sufficient liquidity, even the best assets can become liabilities. Liquidity determines how quickly an asset can be bought or sold without affecting its price. It's vital for executing strategies efficiently. Case study: in 2008, a liquidity freeze in mortgage-backed securities and interbank lending triggered a financial collapse, forcing the Federal Reserve to inject massive liquidity through bailouts and quantitative easing. Investor takeaway: invest in assets with good liquidity, especially if you need to rebalance your portfolio quickly. Lesson 7. Global market trends. No market operates in isolation. Global economic trends shape local opportunities and risks. Dalio stresses the importance of understanding international markets, how geopolitical events and global trade impact asset values. Case study: the impact of China's economic rise and the shift in global supply chains illustrates the need for a global perspective. Investor takeaway: diversify globally and stay aware of international trends to capture emerging opportunities and mitigate regional risks. Lesson 8. Behavioral finance and investor psychology. Successful investing is as much about understanding human behavior as it is about numbers. Investor biases, from overconfidence to herd behavior, can skew market outcomes. Dalio emphasizes self-awareness and rational analysis. Case study: the dot-com bubble, 1995 to 2000, illustrates how investor psychology can distort markets. Fueled by excessive speculation and unrealistic growth expectations, investors disregarded fundamentals, driving tech stock valuations to unsustainable levels. When reality set in, the bubble collapsed, erasing trillions in market value. Dalio highlights such cycles as predictable patterns where irrational exuberance leads to corrections. Investor takeaway: learn to recognize and counteract your own biases. Stick to a disciplined, data-driven approach. Lesson 9. Emotional discipline in trading. Ray Dalio, founder of Bridgewater Associates, emphasizes the importance of emotional discipline in investing. He advocates for a systematic, principles-based approach that relies on data, algorithms, and historical analysis to mitigate the influence of emotions like fear and greed. This methodology is designed to enhance decision-making and promote long-term investment success. Case study: Bridgewater Associates identified the risks leading up to the 2008 financial crisis through its macroeconomic research, particularly concerning excessive debt cycles. The firm adjusted its portfolios accordingly, implementing broader hedging strategies rather than directly shorting subprime mortgage assets. Unlike hedge funds such as Paulson and Company, which profited heavily from shorting mortgage-backed securities, Bridgewater focused on risk-parity strategies and dynamic asset allocation to manage exposure to economic downturns. While Bridgewater successfully positioned itself defensively before the crisis, it did not engage in aggressive shorting of mortgage-related assets. Instead, it relied on a diversified risk management approach, adjusting its portfolio across various asset classes to navigate market turbulence. Investor takeaway: practicing emotional discipline is crucial for investors. Developing a trading plan that minimizes emotional decision-making can lead to more consistent and rational investment outcomes. Lesson 10. Adapting to changing economic environments. The only constant in the economy is change. Adaptability is essential for survival. Economic environments evolve. Dalio's approach stresses the importance of adapting strategies to new realities rather than clinging to outdated models. Case study. In the 1970s, Ray Dalio experienced firsthand how shifts in monetary policy and inflation cycles dramatically affected markets. He learned that ignoring macroeconomic changes can be disastrous. Decades later, this understanding helped him position Bridgewater Associates to navigate changing interest rate environments, inflation spikes, and monetary easing cycles. Investor takeaway: continuously reassess your strategy in response to evolving market conditions. Lesson 11. Building a resilient portfolio. Resilience in a portfolio comes from balancing risk and reward across different scenarios. Dalio's all-weather portfolio is designed to be resilient across economic cycles by balancing risk exposure rather than simply diversifying assets. The strategy ensures that no single economic condition, growth, recession, inflation, or deflation, dominates the portfolio's performance. Case study. During the late 1990s and early 2000s, most investors built portfolios heavily weighted toward equities and tech stocks, making them vulnerable to market crashes like the dot-com bubble and 2008 financial crisis. In contrast, Ray Dalio's all-weather portfolio was designed to be resilient across inflationary, deflationary, growth, and recessionary periods. It balances assets like equities for growth periods, bonds for deflationary conditions, commodities like gold as inflation hedges. This strategy proved effective when economic downturns hit, allowing investors following this approach to recover faster than those with concentrated risk exposure. Investor takeaway: true portfolio resilience comes from risk balancing, not just diversification. Allocating assets based on their risk characteristics can help maintain stability across all economic conditions. Lesson 12. The role of macroeconomic analysis. Understanding macro trends is critical for making sense of market movements. Dalio's approach integrates macroeconomic analysis, studying interest rates, fiscal policies, and geopolitical shifts to inform investment decisions. Case study. The impact of central bank policies during the 2008 crisis shows how macro trends can dictate market behavior. Investor takeaway: stay informed on global economic trends and incorporate them into your investment strategy. Lesson 13. Developing a long-term mindset. Great investing isn't about short-term gains. It's about building wealth over decades. Dalio advocates for a long-term investing approach, but with an emphasis on understanding economic cycles. He does not support passive holding through all conditions. Instead, he stresses the importance of adjusting to macroeconomic shifts. His investment philosophy involves studying historical patterns to anticipate downturns and position accordingly. Case study: market recoveries after major crises, such as the Great Depression and 2008 financial crisis, highlight the benefits of long-term investing. However, Dalio's approach is not simply about riding out downturns. He advises dynamically rebalancing portfolios based on macroeconomic indicators to mitigate risk and capture growth opportunities. Investor takeaway: a long-term mindset is essential for wealth building, but it must be paired with economic awareness and adaptability. Investors should ride out volatility, but also stay informed on macro trends to make strategic adjustments when needed. Lesson 14: radical transparency in decision-making. Success in investing and business comes from confronting reality head-on. Ray Dalio champions radical transparency, a culture where open, honest communication fosters trust, accountability, and more effective decision-making. At Bridgewater Associates, transparency isn't just encouraged, it's systematically embedded into daily operations. Employees are expected to challenge each other's ideas openly, ensuring that decisions are made based on objective reasoning rather than hierarchy. This approach enhances collective intelligence and minimizes blind spots. Case study: Bridgewater operationalizes radical transparency through tools like the dot collector, which allows employees to rate each other's arguments and decision-making in real time. Meetings are often recorded, primarily for training and learning, rather than enforcing compliance. These practices helped Bridgewater navigate economic downturns by fostering candid discussions that identified risks early and enabled swift, data-driven decision-making. Investor takeaway: in both investing and leadership, embracing transparency leads to stronger outcomes. By encouraging open dialogue and rigorous debate, investors and business leaders can reduce biases, improve decision-making, and enhance adaptability in uncertain markets. Radical transparency isn't just about exposing weaknesses. It's a tool for refining strategies and leveraging collective intelligence for long-term success. Lesson 15: the power of idea meritocracy. The best decisions emerge when ideas are judged on their merit, not on who presents them. Ray Dalio's philosophy of idea meritocracy ensures that the best ideas rise to the top, regardless of rank or seniority. At Bridgewater Associates, this means fostering an environment where employees are encouraged to challenge assumptions, debate different perspectives, and refine decisions through open dialogue. This system helps eliminate groupthink and emotional biases, leading to better outcomes. Case study: Bridgewater's principles-based culture empowers employees to engage in radical truth-seeking, especially during market crises. During the 2008 financial crisis, Bridgewater's open debate culture allowed the firm to recognize risks early, adjust strategies, and emerge stronger. The firm's reliance on diverse viewpoints and data-driven decision-making helped it navigate turbulent markets more effectively than many competitors. Investor takeaway: whether in investing or business, surround yourself with people who challenge your thinking. Create a system where decisions are based on logic and evidence, not authority or emotions, ensuring the best strategies prevail. Lesson 16: leveraging data and technology. Technology and data are revolutionizing how we understand and act on market trends. Dalio has long championed the integration of technology into investing, using data-driven systems to enhance decision-making and reduce emotional bias. Bridgewater's strategies rely on algorithmic analysis of vast economic data, helping investors anticipate market shifts with greater accuracy. Case study: Bridgewater Associates pioneered the use of systematic investing, developing sophisticated algorithms that analyze historical and real-time economic data. These tools enable the firm to model macroeconomic relationships and optimize investment strategies, balancing human insight with machine-driven precision. Investor takeaway: Embrace data and technology as key components of your investment approach. Leverage analytics and automation to improve decision-making and gain an edge in an increasingly complex market. Lesson 17. Continuous learning and adaptation. The best investors never stop learning. Adaptation is essential in an ever-changing market. Dalio's success is built on a philosophy of continuous improvement, analyzing past decisions, refining strategies, and adapting to new economic realities. This learning mindset ensures resilience in the face of uncertainty. Case study. After the 2008 financial crisis, Bridgewater conducted a comprehensive review of its risk models and macroeconomic assumptions. By identifying weaknesses and making adjustments, the firm strengthened its ability to navigate future crises, reinforcing its reputation as a leader in adaptive investing. Investor takeaway. Commit to lifelong learning. Regularly assess your investment strategies. Seek out new insights and adjust based on evolving market conditions to ensure long-term success. Lesson 18. The importance of independent thinking. Don't be afraid to challenge conventional wisdom. Independent thinking leads to breakthroughs. Dalio emphasizes that the most successful investors think critically and independently, making decisions based on rigorous analysis rather than market sentiment. He believes that challenging consensus views can lead to superior investment opportunities. Case study. In the early 2000s, Dalio's independent analysis led Bridgewater to predict the 2008 financial crisis before most of Wall Street. While the majority of investors remained optimistic, Bridgewater's research identified excessive debt levels and unsustainable economic trends, prompting them to adjust their portfolios accordingly. As a result, the firm not only avoided massive losses, but profited during the crisis. Investor takeaway. Develop your own research-driven investment approach. Trust data and logic over herd mentality, and be willing to go against the crowd when the evidence supports your view. Lesson 19. The role of credit cycles. Credit is the oil that keeps the economic engine running. However, when credit expands unsustainably, it can lead to severe market corrections. Dalio's framework of economic cycles emphasizes that excessive borrowing often precedes downturns. When credit grows too quickly, it fuels asset bubbles that eventually burst, leading to recessions. Understanding these cycles is crucial for anticipating economic downturns. Case study. Japan's asset bubble in the late 1980s is a prime example of unsustainable credit expansion. Fueled by aggressive lending, Japan's stock and real estate markets soared to unprecedented levels. However, when the Bank of Japan tightened monetary policy in the early 1990s, the bubble burst, triggering the lost decades, a prolonged period of stagnation that saw stock prices and real estate values plummet. This crisis highlights the dangers of excessive credit growth and the long-term consequences of debt-driven booms. Investor takeaway. Monitor credit growth closely. When debt levels surge unsustainably, financial bubbles often follow. Be prepared for tightening cycles and potential downturns. Lesson 20. Final investor takeaways and roadmap to success. In the end, investing is about understanding the world's economic cycles and making decisions that reflect their complex, interconnected nature. Ray Dalio's principles emphasize that investing success comes from recognizing economic cycles, diversifying effectively, and maintaining discipline. His systematic, data-driven approach underscores the importance of adaptability, risk management, and long-term thinking to navigate financial markets successfully. Case study. Dalio's Big Debt Crises framework provides a structured way to understand economic cycles and make informed investment decisions. His analysis of historical debt cycles, such as the 2008 global financial crisis, illustrates how excess credit expansion leads to economic booms followed by painful deleveraging. Investors who understood these cycles and positioned themselves accordingly By holding uncorrelated assets and maintaining liquidity, we're better able to preserve and grow their wealth. By applying Dalio's framework, investors can analyze leading indicators of market downturns, prepare for shifts in monetary policy, and make investment decisions grounded in economic fundamentals rather than short-term market noise. Investor takeaway. To achieve long-term investment success, understand economic cycles and how credit expansions and contractions drive markets. Diversify across asset classes to mitigate risks and adapt to changing conditions. Maintain discipline and avoid emotional decision-making, especially during downturns. By incorporating these principles, investors can... Thank you for joining us on this journey through Ray Dalio's essential 20 lessons in investing. Which lesson has stuck with you? Share your thoughts in the comments below, and don't forget to like, subscribe, and click the bell icon for more investing insights from Moon and Margin. Thanks for watching, and talk to you soon.